Welcome to Retire Coast, where we discuss all things retirement, life on the Mississippi Gulf Coast, and your financial welfare. Bill Anderson, your host, is a serial entrepreneur having created many successful businesses and holds a real estate broker's license, speaks about personal experiences with each topic. Listen, learn, and improve the quality of your life.
Welcome back to Retire Coast podcast. We're going to talk today about your income taxes in 2024. That means that when you finish this year, you will be filing in the year 2025, which is next year, the tax return for this current year. Now, a lot of times we don't really get around to talking much about income taxes until at the end of the year when there's hardly any time left to do anything about improving your situation. So let me start out by telling you that the current tax system is going to come to a crashing halt at the end of 2024, which is this year, unless Congress reauthorizes it. And I can't tell you that there's any progress there. There's discussion, of course, but this is an election year, so it may be difficult to get anything passed regarding the extenuation of the current changes that were made in 2017 because both parties don't necessarily agree with them. As a matter of fact, when the bill was passed in 2017, the Republicans passed it with their majority. The Democrats voted against it. Now, that doesn't mean that the Democrats didn't like it, but that's politics for you. They didn't put the bill up, so therefore they voted against it. Now, that doesn't also mean that this tax system we have today is going to completely go away, but it may go away, and that means you need to do something about it. So we're going to talk a little bit about what you can do to improve your tax situation, assuming that this is the last year of the larger standard deduction and the lower tax rate tables. So let me get into the differences for you just to explain. In 2017, I'm talking about married filing jointly now. In 2017, prior to the tax cut bill, there were a number of tax rates, if you will, 10%, 15%, 25%, 28%, 33%, 35%, and, stratospheric number. Okay, so all of those were the tax rates that you would apply to a certain income. Let me give an example. The 15% tax rate applied to $18,551 to $75,900. Now, that is a tax rate applied to your tax return after all of your deductions are made. So it's not your gross income. The 25% tax bracket was $75,000 to $118,000, and then it went up from there. So we had about five tax rates that would, maybe six, that would affect most of the people listening to me today. So Congress made many changes to the tax tables and to the standard deductions. So let me explain how that went. Now, I know it's hard for you to picture all of this while you're listening as opposed to seeing it, and I'm going to direct you to an article that I'm writing where you'll see the actual tax tables. So after 2017, married filing jointly had tax rates of 10% and 12%, not 15 but 12, so that went down too. The 25% went down to 22%, and the larger tax rate of 28% went down to 24%, and then now the newest one is 32%. So basically the tax rates for everything after your deductions are all taken out went down, and the dollar amounts also went up, which is good. In other words, at 12%, you can earn as much as $20,551 to $83,550 and pay 12% in taxes as opposed to the previous 15% for even earning less money. So this was a significant change to the tax system and allowed all of us to keep more money. What they also did was the IRS instructed employers to reduce the amount of money they were taking out of paychecks because it wasn't necessary. So you weren't even required to fill out one of those forms where you're saying, hey, I've got 16 dependents or whatever. They automatically reduced it. For some people who wanted to adjust it even more, of course, you can certainly turn in a tax form and claim certain number of exemptions. But basically, everybody paid less in taxes. So there's another element in that, too, and that is the standard deduction. Now, the pre-1917 standard deduction for a married couple was $18,550. And, of course, that you know what the standard deduction is. Instead of putting down that you've got a mortgage and you've got taxes and you've got this and you've got all these receipts for money you donated, and et cetera, if you add all that up together and doesn't hit the total standard deductions, then there's no reason to use any of that. Just take the standard deduction and you just keep on moving on. So the standard deduction went from $18,550 to a whopping $27,700 in 2023, and it'll be even higher for taxes for 2024. It's going up to $29,200, which means that you gather in all of your expenses together. And if you can't exceed $29,200, then you take the standard deduction. If you can exceed that, then you're welcome to do the itemized deduction on your tax return. But apparently, according to the IRS, the vast majority of people are under the standard deduction, which makes doing your tax return so much simpler. There's no reason to gather all those receipts and have all that filing and everything else, pay lots of people to go out there and do tax returns when it's not necessary. As a matter of fact, the seniors have a single form now. It's called an SR form. That is very simple. It's basically a page and a half, and there's very little that goes on that. Most of it's just information about you. But according to IRS, in 2020, 90% of taxpayers used the standard deduction. Now, that's huge. That makes it a lot simpler. It cut down, as I said, on the cost of preparing taxes and the ease. Instead of having file drawers full of things you have to keep back years and years and years, there's no reason to have all those receipts. So there's no doubt in anybody's mind, should be no doubt, that those tax reforms that were put into place in 2017 have helped the average American. Now, there are people at the very bottom who didn't pay taxes anyway, and there's no change there, and people at the very top that will also benefit. The benefits drop down as you get higher income, goes way up. But nevertheless, that's what you hear a lot of times in the news, depending on who's talking about it, that, rich people got a big benefit. Well, you know what? Everybody got a benefit, and the vast majority of the population got a benefit. And that's what is important. They hit the target with that. So if this bill, which is going to sunset or expire at the end of 2024, means that the taxes that you will pay in 2025 will go up, then there's something you need to do about it now instead of waiting. Now, usually we kind of wait until, the end of the year and start getting into all the advice about taxes. And I'm telling you the advice that you need, take it now and do some planning for the end of the year. There is an excellent chance that Congress, with the election coming up, may not get to making the changes soon enough, if they're going to make any at all in our interest, to keep this thing going. So I think it's the best bet is to assume that this will be the last year. So you need to take advantage of this tax system right now, this year, and that means a lot of things. So let me just hit the retired people here. Anyone that's 59 and a half or older can remove money from your 401k or your IRA that you never paid taxes on, and you can take that money out without paying that 10% penalty. You still have to pay taxes on it. The point I'm getting at here is If you're going to take some of this money out anyway, and maybe next year, it might be better off for you to take it out this year at a definite lower tax rate. I don't think the tax rate is going to be reduced next year. So if for some reason Congress extends this, that's just fine. You've done okay, but it could be worse. So I think if you go on the worst case scenario, this might be a good year to start taking the money out of those accounts. Now, I've talked about this before in other podcasts. You need to drain those accounts that you have to pay taxes on at a rate in which you are comfortable paying the taxes, and there's some advantages. So you have, with this large standard deduction, you can take out some of that money, and of course we have lower tax tables. So you might want to hit the 12% bracket instead of the old 15% bracket by stopping at, say, $50,000 or some number like that. The other thing you can do is you can deposit some of that money into a Roth IRA, which you can open. Now, that limits on that are $7,000 or $8,000, depending on your age, and it changes every year. At least to get some of that money into that Roth IRA, where you will never pay taxes on the income, and you can always take out the principal. I'm not going to get into all of that here because you can read about this on our website and also other blogs that I've talked about. Nevertheless, there's a way for you to just take the funds out of those programs, the 401k and the IRA, and you can reinvest it. You can reinvest the stock, mutual funds, all that, in the same things that you had it in already. Just move them over. Some accounts will allow you to do that. Some brokerage houses will allow you to just swap it out and move it out of those accounts into a regular brokerage account. Now, the income you earn on the brokerage account will be taxable, but at least you will have paid the taxes on the principal. So that's a good move, a good way for you to soak up some of that standard deduction if you don't use it all anyway, depending on your income. If you're a relatively high-income individual, again, you still have lower tax brackets, so it's a good time to move that money. It's also a good time to make purchases for things that are deductible. If you decide you're going to file the long form and take the not standard deduction but the regular deductions, it's time to spend and buy anything and everything that you can if you have the funds to do so, for a couple of reasons. One, we're in an inflationary cycle right now, so things are going to be more expensive tomorrow than they are today. So buying them today, especially if they're durable goods, will be a smart thing. Taking advantage of the lower tax rate is even better. And if you're in business, remember that the limited liability companies have a really great tax bonus that was included in the 2017 tax bill. You should look into with your CPA, plus that all those profits that come from your LLC run through your own tax return, which means that you'll be paying at lower tax rates in 2024 in the event that Congress does not renew the 2017 tax bill. So this is the time to get spending if that's the case for you. If you have the funds and it makes sense to do so, just do some analysis. It doesn't take a lot. You can use a spreadsheet and kind of work it out. Go to the IRS website if you want to take a look at the tax tables there. You can also go to our website at retirecoast.com and check a number of articles that we have there that we'll have listed in the notes for this podcast that talk about the planning process for your 2024 taxes. Pretty much what we talked about in here, but we'll give you some places to go to do some calculating. For those of you that are a little bit politically active or want to be somewhat active, you can always check with the House Ways and Means Committee. This is where the tax bills originate, and they're the ones that have to take this up in order to make it happen again. Now, from what I can understand, from what I've been reading to date, there hasn't been any decision. There's no bill on the floor to extend the tax provisions of the 2017 changes. The Democrats tend to favor leaving the changes in place for the middle class, and it's been no description about what middle class means here. The Republicans want to leave the entire thing in place. The Democrats want to push out all of the changes that are made to people in higher income tax brackets without explaining what those higher income tax brackets are. So obviously politics are heavily involved here, and it may be that this bill, a bill, does not get voted on and signed into law with the current administration unless the current administration gets reelected. So based on all of the information available, it's a prudent move for you to assume that the 2017 tax cuts are going to go away and that you need to take action for planning this year for your taxes and probably do some things this year that you might push off till 2025 or 26 and just accelerate those. There are a lot of benefits that were actually crammed into that tax cut that allow for accelerated depreciation. For those of you that are not in business, it doesn't really mean anything for you, but if you have a small business there and you buy something big and you normally would depreciate it over, say, a period of 5 years, you can, in large part, depreciate it all in the first year, which means you're going to write it all off at one time. So check with your CPA on those things. All of that will go away also with the 2017 tax cuts, unless, again, Congress reauthorizes the 2017 Jobs Act, what they call the Tax Cuts and Jobs Act. So keep in touch with the Congressional Budget Office, with the Tax Policy Center, with the House Ways and Means Committee, and you might want to vote for this by deciding who you want to elect as a new president, because this is a federal issue and the president will be leading the charge one way or the other on this, depending on the party that's elected. So you might want to look into it. It has been brought up in a number of discussions, and if you can listen hard, you'll hear it. You'll hear positions from both presidential candidates on this. Well, thank you very much for listening to our podcast. I hope that you jump to it and take some of the advice that we have provided to you here and take advantage of this, I think, a terrific change in the law for everybody. Make it easier and do what you need to do this year instead of putting it off until the end of the year. So please come back and listen to our podcasts on retirecoast.com, and also go to our website, retirecoast.com, because we have a lot of articles, particularly dealing with finance and retirement. Thank you for listening.